Alphabet recently reported their Q4 and full year 2024 results to rather negative market reaction. Now, I'm not going to get into, their cloud business growing at 30% instead of 33 as if that signaled some sort of AI Armageddon coming when you have a business that's supply constrained. I think that's rather foolish. I think investors are more so worried about the Capex step up by about 19, 20 billion to between 76 and 78 billion. I forget the exact number that was quoted, but again, it's not exactly relevant for this discussion. I just wanted to get back into sort of ground ourselves in terms of what does this mean for firm value? What does this mean for the actual value of the company? If you invest in a project that generates an IRR in excess of your cost of capital or your hurdle rate, if you will, that project will add value to your firm in the present. Okay? So just because a firm is spending money today, you should not dump them, or that doesn't mean they're less valuable. It actually might mean in most cases, especially if you have good management, that the value of the company should actually have increased, right? Especially if you believe in the long-term efficacy of that capex, right? The logic of seeing lower free cash flow in the near term to support future growth and sort of via that investment, and then slapping an identical multiple on that lower cash flow, and then arguing that the business is now less valuable. Well, that's sort of the math that is incredibly foolish and is done by the people who will lose long term in the market. It's not really that complicated. Majority of firm value is terminal and is into the future. In fact, if Google made $0 in free cash flow for the next 2 years, you should only discount them by about 4 to 5%. Depending on what discount rate you want to use. But Google dropped 7-8% today on a CapEx step up that represents less than 1% of the total market cap. Again, completely irrational, doesn't really make sense. So in this case, let's explore the CapEx efficacy of sort of this infrastructure build out that Google's sort of undertaking right now. To start this discussion, I just want to point to the fact that Google's return on invested capital, if we use pre-tax income, again, it doesn't really change the point. I just like to look at operating income, is in excess of 45%. This is well in excess of a hurdle rate or the cost of capital to Google. So they've been generating sort of excess shareholder returns by virtue of them investing in the present to generate future returns. Well, what about near-term capex? Well, if you look at that figure on an incremental basis, the incremental return on invested capital from incremental spend over the last 5 years, and by the way, this same sentiment holds true if you change that window length, is still in the 40% range. What does this mean? Well, this means that it's very likely that Google's capital expenditure step up is going to be met with future earnings increases, again, in and around that historical return on invested capital range. Just to give you sort of clarity on that figure, if Google gets a 20% return on invested capital on that $76, $78 billion figure, whatever it ends up being, Google's pre-tax net income, Google's operating income, or Alphabet's operating income rather, their pre-tax income, will increase by around 13%. Well, that's roughly in line with the growth of the Google business as a whole, of the Alphabet business as a whole. So the actual CapEx that is being spent isn't actually that asinine. The issue is the fact that infrastructure build-out has inherently lower returns on invested capital. I read a recent report by an investment research company that pegged the normalized yield of data centers as of 2024 summer to be roughly around the 10% range. Now, this is still in excess of hurdle rates and costs of capital, especially for these small firms for which most of these data points were collected. And for Google, we might even expect that return metric or that normalized yield metric to be even higher in terms of once these data centers and once these infrastructure rollouts are online, their cash flow yield should be in excess of up 10%. If it gets to the 20 pre-tax or around 15, again, you have that sort of linked to that 13% operating income growth. But the point is that as long, and I want to be very clear about this, as long as the internal rate of return is greater than the hurdle rate, you will add value to the company, okay? The company becomes more valuable. So if you are a Google investor and they tell you they're going to invest in GCP, which is growing at 30% a year, and it is undergoing margin expansion, and they're investing in sort of infrastructure rollout to support the entire business in the new AI age. To me, I don't really see the caveat, though, is you need the capex to sort of defend or bolster your competitive advantage and your reason for outsized returns in the future. And I guess if you're Google, that is still kind of up in the air. But again, I'm looking at all these infrastructure plays and all these AI plays, and you look at all the capex that's been generated. Google is one of the only companies that's actually has a viable business strategy for AI that's clear. It's being it's in play right now. It's being developed, and their models are, with all due respect, are the Pareto frontier. They're the most efficient models. They have the best performance relative to cost. Period. They're the best performing and are the best cost, lowest costing, and that cost is a factor of 10%, actually lower than 10% to the next nearest model in the same sort of quality sphere. So when I look at their vertically integrated AI strategy, I'm looking at a pretty good strategy. It's already playing out. It's already producing advantages over competitors. So when I'm looking at that spend, I'm looking at that spend as bolstering a competitive advantage, at providing incremental returns in excess of hurdle rates. So before they told me they were going to step up their capex, I now think the firm is more valuable. Again, it's just little things like this where if you're not privy to firm value, you don't understand firm value enough, events like these, news articles like these, they shake your sort of they might shake your thesis or the way you feel about companies. But remember, it's follow the valuation, follow the cash flows, and then the market price is just an exogenous variable. It's just something that you decide whether to buy or sell against, and it has no bearing on your opinion of the company. That is how you invest. And for that help, that's why, we're powered by ValueGap. It really helps us ground the true value of a company completely detached from market prices. ValueGap is powered by Gemini. It is the best and most efficient model, period. Nothing even comes close. So, we're proud Google shareholders, and, again, follow the value and, stay tuned for more. Thanks.